Good morning. Thanks very much, David. Thanks for asking me. Thanks very much, Jeff, for a brilliant introduction to Zopa. You've saved me the first page of my presentation, and the numbers you were quoting were pretty well spot on, so thanks for that. I'm actually here to talk about innovation rather than Zopa, and use perhaps Zopa as a bit of an example of what I believe is important about innovation. And I want to talk about genuine customer-focused innovation and how that kind of innovation can help build trust. And trust is obviously something that's really important in this area of financial services and in the context of the loss of trust that they've suffered. So I'm sure many of you have heard the quote from Paul Volcker, the ex-chairman of the Fed, who said that the most important innovation in financial services in the last 20 years was the ATM. That's kind of sad. He said that in 2009. And I think he said that in the context of the credit crisis and the growing sort of realization that all the ingeniousness and all the cleverness and all the smarts in this part of the world and on Wall Street hadn't actually filtered down into any consumer value or any consumer benefit. And if anything, it had caused pretty massive consumer loss. So given the really poor record of innovation, I believe, in financial services, I think we need to look outside of that particular sector to look for good examples. And I want to talk about consumer value-focused innovation. So the kind of innovation which takes a value chain and says there are certain things in this experience that are important to consumers and we need to work on how to improve them and develop them further. And there are some other things in the value chain that consumers don't value. So we can look to remove them. And a really obvious example of that is from the airline industry. So Southwest Airlines in the States, copied by Ryanair and EasyJet over in Europe, looked at a very, very complicated customer proposition called air travel and worked out that there were some things within the existing model that people didn't value. One of them was food on a plane, for example. Another was having a guaranteed seat. But there were some things they really did value. One of them was punctuality. Another one was the low cost of travel. And you can say what you like about Ryanair and the criticism it gets for customer services, but it's built a really enormous and successful business off the back of what I call value innovation. But I want to tell you a story from another sector, and it's a sector I know quite well. I spent the first 10 years of my career in the motor industry, quite far removed from financial services. And I want to tell you a story that I learned from that industry. So about 40 years ago, when I'm sure many people in the room own a car and take your car in for service. So about 40 years ago, the customer experience of taking your car for a service was taking your car to a very large, probably quite flashy car dealership on the outside of town. So almost by definition, nowhere near anywhere that you actually work. So a rather useless place to travel to. You were encouraged, therefore, to take your car in at the beginning of the day, along with everybody else. It's a bit like checking in and out of hotels. Everyone wants to do it at the same time. So you have a pretty horrible customer experience. You then very unusually have a very odd retail experience. You buy something you don't understand. So typically when we go into a shop to buy a pair of jeans or buy an iPad, we're sort of pretty familiar with what we've got and we value it accordingly. If you're taking a car in for service, you buy a thing called labour. Now labour doesn't really mean much to very many people, but what's shocking about it is it's very expensive. So the average labour rate for a car service inside London now is reaching £200 an hour, which is about the same as you pay a junior city lawyer or junior accountant. And the justification for that really high cost is that you're paying for the enormous expertise of the highly trained mechanic, which may or may not be true, and the expense of the facilities you're in and all the equipment that you use. But customers hated this experience. So they take the car into this dealership. They then got to get to work, so they have to take a bus or something like that. They then have to repeat the whole horrible experience at the end of the day, and then they pay what they consider as a very high price for a very poor service. And customer research, for as long as I've known anything about the motor trade, has been completely overwhelmingly clear. It's an experience that people are fundamentally unsatisfied by. In 1971, a Glaswegian entrepreneur, a young Glaswegian entrepreneur who just sold his first business, thought there has to be a better way to do this. He was on holiday in the States, traveling around. He'd just sold his first business. And he noted with interest these things called muffler shops. So muffler is American for an exhaust. And he worked out quite quickly that there were a range of parts you could fit to a car which had a very, very high retail margin. And because they had a very high retail margin, you could effectively not charge for labour. You simply sell the part and the labour comes free. These parts could be fitted very quickly. They could be fitted by people with almost no training. Anyone in this room could change a tyre given 20 minutes training. They also typically didn't require big inventories, so most car tyres go on most cars. So within reason, you can end up locating these facilities in quite small places, so you can put them somewhere convenient. So amazingly enough, they started appearing on high streets. Tom Farmer founded a business called KwikFit, which I'm sure everyone's heard of, which of course was copied by many, many people in the UK and Europe, because like most successful disruptive companies, they get copied. However, the copying didn't matter because they took so much share that the market they were playing in was plenty big enough to serve them and their competitors. The UK after-sales market for car servicing is about £8 billion a year. Of that, about 15%, so £1 billion a year, is in tyres and exhausts and other quick-fit type items. Today, or in fact by about 1990, so only 20 years after the launch of KwikFit, the entire business had gone. So the service sector had gone from 8 billion after-sales revenues to 7, and this new sector had taken the entire business. It will never go back. Now, they won on every dimension. They provided a product that was better value, that offered better service, that was more convenient. It was simply a better product on every single dimension. So why am I telling you the story? Well, apart from that, I like the story, and it's from an industry that I have a lot of affection for. I think there are some quite strong and interesting parallels with peer-to-peer lending. So what we did was we took a product, or we took a subset, if you like, of banking and said, what can we do within this broad banking offering that's better by focusing on a narrow sector? So how can we take cost out of a narrow sector of banking and simply do that better? And in a perfect world, do it better on every dimension in the same way that KwikFit did. So if you look at what banks do and try and break down the sort of core components of banking, I think probably most people would agree the most important thing that they do is manage risk. So they have credit and risk functions. As Jeff so beautifully presented, I think we manage credit and risk better than any UK lender. Our default rates are a fraction of any other. And I think the advantage of the reason why we're better at it is we just started it at a good time. We started it when consumers were over indebted. We looked at them slightly differently, and we built a better model. So to some extent, there was some fortune in the timing of our launch and bringing some new thinking to bear on a sector that was viewing its activities very traditionally. Other things banks do, and they obviously market their products. We do that. They run operations, so they make sure that people pay the right amount of money and people get paid the right amount of money. So a sort of back office operations function. But there's a really important bit of banking that we don't do, and that bit of banking is called treasury. So the treasury function in a bank is the bit that allows them to, forgive the jargon, to borrow short and lend long. They borrow short by taking deposits, and they lend long to borrowers. It's got a term which is well known by, which is called fractional reserve banking. I have heard fractional reserve banking described as the greatest invention, industrial invention since the wheel. Paul Volcker obviously didn't agree with that term. But one of the great things fractional reserve banking does is allow banks to manufacture money and create liquidity. But it also is incredibly complicated. It requires government support. And when it blows up, you get credit crises. So the credit crisis of 2008 was a result of that model blowing up. So I think if we can focus simply on providing, as I said, a narrow range of banking products, we can simply provide a better product. Now, it limits what we can do. So we can't provide current accounts. We can't provide credit cards, because to do so would require paying a return on money that we've had from our savers but haven't lent out yet to our borrowers. So the model depends on a very simple one-to-one matching. It allows us to provide a predictable return to our savers in return for lending it for a predictable period of time. So we're limited to some extent by what we can do. But I don't mind too much being limited. The unsecured personal loans market's worth £20 billion a year in the UK. We've got about 1% of it now. If we were to achieve, pick a number, 30, 40% of that market, we'd be still under 1% of the savings industry in the UK that would be required to fund that market. So the opportunity for growth simply remaining in the UK is enormous. There's a business in the States called Lending Club that's on track to lend probably $2 billion this year. So within the same narrow product set. So the opportunity is enormous. Because the loans are unsecured, we don't have really complicated administration to do. We don't have to worry about taking security. So the administration of the business is made really, really simple. We also don't have a branch network. Now, branches are really interesting things because if you talk to a room full of bankers, then bankers will always justify the branch network. And they justify it on the basis of the really strong relationship they build with their customers through that network. And they talk a lot about how, for example, I met quite a high-profile new entrant into the banking world who talks about the really strong economics of branch-based deposits. So what he's basically saying, if you remove the jargon, is he's saying he can pay people who physically give him money less than the smart customers who go shopping for a better deal online. Similarly, in the credit crisis, people talked a lot about how there was a sort of capital flight. So the really successful online deposit takers like ING Direct found that many more people took their money out of those businesses than took money out of bank branches. So my view is, why not try and solve those problems? Why not make online deposits sticky? And a case in point might be to agree to lend them for a fixed period of time. And why not provide the better service that branches provide while offering the better value of the online offering? A recent survey by the American Bankers Association, by the way, confirmed that 57% of Americans over the age of 55 did all their banking online now. And that's a number that's obviously much higher for the younger generations. And what I find extraordinary is that banks continue to invest more and more and more money in this offline offering and neglect the channel, which I think is where their growth should come, and have a substandard offering in mobile and online banking. So I think that consumers put the greatest importance in value and not some kind of rather flawed relationship which the bank is trying to foster. And that brings me to the second thing I want to talk about, which is about trust. And I think loss of trust comes from not putting your customers first and at the centre of what you do, and from using the undoubted cleverness of all the really smart people who work in Canary Wharf and Wall Street, and directing them not in the interest of their customers, but in the interest of maximising the profit of the institution that they work for. And at worst, you can see how this is exemplified through scandals like PPI mis-selling, interest rate interest rate swaps, and alleged failure of money laundering practices from global banks and things like that. So I think you're seeing the evidence, if you like, of this flawed relationship. If we move to investment banking, the clearest example, I think, of banks forgetting who their customers are banks taking bets, derivative bets, if you like, and trading against their customers. So what to do? Well, I think these things would never have happened if banks design products and services that do provide genuine value and put their customers first and not their P&L. So I'm not sort of advocating some kind of altruistic nirvana, but I do think you can have businesses which put customer service at their fore and customer experience at their fore doing extraordinarily well. And I think an example like Apple or Zappos springs to mind, are businesses that place that kind of relationship with their customers absolutely at the fore. In the meantime, I think that leaves a great opportunity for businesses like us and many other people in this room who are focusing on a relatively narrow sector through a purely value-based proposition, and a value-based proposition aimed at simply their customers. And I think that allows businesses with this mindset to achieve the kind of success that KwikFit and the other disruptors in the motor industry achieved in their segment. And I think that's what disruption's all about. Thank you.
So Giles, I don't know if it's fair to call Zopa a startup now, because I think you were founded nearly 10 years ago.
Yeah, we got together in 2004 and launched in March 2005.
And so we're hearing a lot more about your growth lately, but it wasn't always on that exponential curve. Why do you think it took quite a while for Zopa to make its impact?
I think we were asking people to do something radically different. So we were asking people to trust strangers with money. Without a track record, that's quite a hard sell. And I think we needed to demonstrate that we actually knew what we were doing to get beyond the early adopter crowd who simply liked the idea into the mainstream. And if you look at the changing profile of our customers, they've got older and wealthier over time. I think it's becoming a mainstream thing to do with your money. Whereas I think in 2005, Jeff alluded to it earlier, there were some skeptics saying you're going to lend money to strangers on the internet and expect to get it back.
And was there an aha moment? Was there a particular time when you thought, we've just cracked it?
Well, the credit crisis helped perversely because we were able to stand up and say, and point to the numbers that Jeff showed earlier and say that the world's falling apart, but actually we've done a really good job in this period. And of course, customers lost faith in banks and financially got a materially worse deal. So the strength of the proposition improved. And I think that's when the growth really started. But I think when we're in a fortunate position that growth's been accelerating for the last 3 years. And I think that's just because it's become more mass adopted.
And you talked about trust. We carried a great feature from Rachel Botsman arguing the case that we will eventually have a portable metric that says how you can trust us in all our online transactions that will take in, your eBay credit, your credit score, your clout score. Do you see something like this becoming a norm?
I see huge opportunity for it. I think what we don't see an opportunity for is a sort of internal company-based metric, because we don't lend money often enough to people for that to become a valid predictor. In fact, if anything, if you lend money too often to people, then that's a pretty bad sign rather than a good sign. So I think that has to come through collaboration of a wider variety of businesses than simply lending businesses like ours.
Well, look, thank you for taking the time. From
Thank
Zopa,
you.
Giles Andrews.